Um, I want to tell you about the worst day of my investing career, a day that cost me $23 billion in paper losses in just 24 hours. $23 billion. That's more than most people, most companies, even most countries will see in their entire existence. In one day, a huge portion of my life's work evaporated. And here's what made it even worse. It was entirely my fault. I made a mistake, a massive error in judgment, and the market punished me for it swiftly and brutally. Now, you might expect that losing $23 billion would crush someone, would cause panic and regret and sleepless nights replaying the decision over and over, but that's not what happened. Instead, that terrible day taught me lessons that made me a better investor, lessons that have since generated far more than $23 billion in additional returns. Today, I'm going to tell you exactly what happened, why I lost so much money, and most importantly, what I learned from the experience. Because the lessons from failure are often more valuable than the lessons from success. And if you can learn from my $23 billion mistake without having to pay that price yourself, you'll be a much better investor. The day was Monday, October 19th, 1987. It's remembered as Black Monday, the worst single-day percentage decline in stock market history. The Dow Jones Industrial Average fell 22.6% in one day, 22.6%. For context, the crash of 1929 that started the Great Depression saw the market fall 12.8% on Black Tuesday. The flash crash of 2010 was a 9.2% intraday decline. The COVID crash in March 2020 saw the Dow fall nearly 13% on its worst day. Black Monday was worse than all of them. It was sudden, violent, and nearly unprecedented. Berkshire Hathaway didn't fall 22% that day. We fell much more. At one point during the day, Berkshire's stock was down over 30%. The value of the company, my net worth, and the wealth of all our shareholders was being destroyed at a rate of about $1 billion per hour. By the end of the day, Berkshire had lost roughly $23 billion in market value, and the losses continued in the following days and weeks. Within a month, Berkshire was down about 35 to 40% from its peak just weeks earlier. Now, you need to understand something about my situation. In October of 1987, I was 57 years old. I'd been investing professionally for over 30 years. Berkshire Hathaway had grown from a struggling textile company I bought in the mid-1960s into one of the most successful investment vehicles in history. Our stock had compounded at over 20% annually for more than 2 decades. I was one of the wealthiest people in America. I had a reputation as one of the best investors in the world. And in one day, a huge portion of that wealth simply vanished. What made it particularly painful was that I saw the crash coming, or at least I saw that the market was becoming dangerous. In the months before Black Monday, stock valuations had become stretched. The market had risen strongly for several years. Price-to-earnings ratios were elevated. There was increasing speculation. Junk bond issuance was accelerating to fund leveraged buyouts. Portfolio insurance, a form of computerized trading that automatically sold stocks when prices fell, had become popular among institutional investors. I knew these were warning signs. I'd lived through market crashes before. I understood what late cycle behavior looked like, but I didn't act on what I saw. I didn't sell stocks aggressively. I didn't raise cash to significant levels. I remained heavily invested because I thought the businesses we owned were good businesses that would be worth more in the long run. I was thinking about business value, not market price. And that distinction, which usually serves investors well, cost me dearly in this instance, because when the market crashed, it didn't matter that we owned good businesses. Everything got crushed. The baby got thrown out with the bathwater. Berkshire, despite being financially strong with quality assets, fell more than the market because we had significant equity holdings that all declined simultaneously. Let me walk you through what actually happened on Black Monday, because understanding the mechanics of the crash is important context for the lessons. The crash started in Hong Kong and New Zealand on the morning of October 19th, their time, which was Sunday evening, October 18th, U.S. time. Asian markets fell sharply. When European markets opened Monday morning, they fell as well. By the time U.S. markets opened at 9:30 a.m. Eastern, selling pressure was already enormous. The Dow opened down significantly and just kept falling. There was no particular news driving the decline. No war, no terrorist attack, no corporate scandal. It was pure selling momentum fed by portfolio insurance programs that automatically sold into weakness, which created more weakness, which triggered more automatic selling. It was a self-reinforcing crash. The trading systems of the time couldn't handle the volume. Orders were delayed by hours. Many stocks stopped trading entirely because there were no buyers. Investors couldn't get prices or execute trades. It was chaos. I remember sitting in my office in Omaha watching the tape, just watching billions of dollars of value disappear. Berkshire stock was trading but falling relentlessly. Our holdings in capital cities, ABC, Washington Post, Geico, Coca-Cola, all dropping. The phone was ringing constantly. Shareholders panicking, asking what to do. Employees worried about their stock options and retirement accounts. Media calling for commentary. And I had no good answers. Because the truth was, I didn't know if this was the start of another Great Depression or just a temporary panic. That uncertainty, that not knowing whether the world was ending or whether this was just a bad day, that was psychologically difficult. When you lose $23 billion, you ask yourself questions. Did I miss something? Is my whole investment philosophy wrong? Should I have seen this coming and positioned differently? Am I too old and out of touch? Maybe the young guys with computers and sophisticated models know something I don't. The self-doubt creeps in, especially when the losses are that large and that sudden. But here's the critical thing. I didn't panic. I didn't sell. Even as Berkshire dropped 30% in a day, even as my net worth was being destroyed in real time, I didn't hit the sell button. Why? Because I went back to first principles. I asked myself, have the businesses we own fundamentally changed? Is Coca-Cola suddenly a bad business because its stock fell 20% today? Is the Washington Post going to stop printing newspapers? Is Geico going to stop selling insurance? The answer to all those questions was no. The businesses were the same on October 19th as they were on October 16th. Only the prices had changed. This is the first major lesson I learned from losing $23 billion. Price is not value. The stock market is a voting machine in the short term and a weighing machine in the long term. On Black Monday, the voting machine went haywire. Panic, fear, and automatic selling algorithms determine prices. But the weighing machine, the actual value of businesses based on their ability to generate cash flows over time, that hadn't changed. The market was offering to sell me good businesses at much lower prices than they were worth. That's opportunity, not catastrophe. If I had panicked and sold on Black Monday or in the days after, I would have locked in those $23 billion in losses. They would have been permanent, but I didn't sell, I held. And within 2 years, Berkshire had recovered all the losses and moved to new highs. Within 5 years, we were dramatically higher. The businesses continued generating cash, compounding value, growing intrinsic worth. The market eventually recognized that value. The shareholders who held through the crash were rewarded. The ones who sold locked in catastrophic losses. The second lesson I learned is about leverage. Berkshire was not leveraged in October 1987. We had no debt at the holding company level. We owned our assets free and clear. This meant that even as stock prices collapsed, we had no margin calls, no forced selling, no creditors demanding payment. We could ride out the storm because we had financial strength. Many investors and institutions weren't so fortunate. They had borrowed money to buy stocks, thinking leverage would amplify their gains. When stocks fell, they faced margin calls. They had to sell into the crash at terrible prices, locking in losses and often going bankrupt. I saw investors, I knew smart people, get completely wiped out on Black Monday because they used leverage. They might have owned good businesses, but it didn't matter. When their brokers issued margin calls and they couldn't meet them, their positions were liquidated at the worst possible prices. Some people lost everything, went from millionaires to broke in a day. The only reason I survived with my wealth intact was that I never used significant leverage. The lesson is simple but crucial. Never risk what you have and need for what you don't have and don't need. Leverage violates this rule. It puts you at risk of ruin, even if you're right about the fundamentals. The third lesson is about diversification, but not in the way most people think about it. Berkshire's losses were large in absolute dollars, but manageable in percentage terms relative to our diversified holdings. We didn't have everything in one stock or one sector. We owned insurance companies, newspapers, manufacturing businesses, marketable securities in various industries. When the market crashed, everything fell, but different businesses fell different amounts and recovered at different rates. The diversification meant we weren't dependent on any single investment being right. If one business or holding struggled, others could carry the weight. But here's the nuance. We weren't excessively diversified. We didn't own hundreds of stocks or businesses. We had concentrated positions in companies we understood deeply and had high conviction about. This is the balance that's hard to strike. Enough diversification to manage risk, but not so much that you dilute returns by owning mediocre businesses. Black Monday reinforced that Berkshire's level of diversification, roughly 10 to 20 major holdings across different industries, was about right. The fourth lesson is about emotional control. Losing $23 billion in a day tests your psychology in ways that nothing else can. Your natural instinct is to do something, to act, to stop the bleeding. Selling feels like you're taking control, making a decision, protecting yourself from further losses. But often the right decision is to do nothing, to sit there and take the pain, to accept that you can't control market prices in the short term, and that trying to do so usually makes things worse. I've always said that the stock market is designed to transfer money from the active to the patient. Black Monday was a perfect example. The investors who acted on their fear, who sold into the panic, who tried to protect themselves by getting out, they locked in losses. The investors who did nothing, who were patient, who could tolerate the psychological pain of watching their net worth collapse, they recovered and thrived. Emotional control, the ability to remain rational when everyone around you is panicking, is perhaps the most valuable trait in investing. The fifth lesson is about the inevitability of volatility. Before Black Monday, I intellectually understood that markets were volatile and would periodically crash. I'd lived through several corrections and bear markets, but experiencing a 22% single-day decline, watching billions of dollars of value evaporate in hours, that hammered home the lesson in a visceral way. If you're going to invest in stocks, you're going to experience volatility. Not might experience, will experience. There will be days, weeks, months where the value of your holdings falls dramatically through no fault of your own and for no rational reason. You have to be psychologically and financially prepared for this. If you can't handle watching your net worth fall 30 or 40%, you shouldn't be heavily invested in stocks. If you need your money in the short term and can't afford to ride out volatility, stocks are wrong for you. But if you can accept volatility as the price of admission for the long-term returns that stocks provide, if you can look through the short-term noise to the long-term value creation, then you can be successful. Black Monday taught me that accepting volatility isn't just an intellectual exercise. It's an emotional and psychological requirement. The sixth lesson is about market efficiency, or more accurately, the lack thereof. The efficient market hypothesis says that markets quickly incorporate all available information into prices, that you can't consistently beat the market because any edge you think you have is already reflected in prices. Black Monday destroyed any remaining belief I had in efficient markets. The businesses Berkshire owned didn't change fundamentally on October 19th. Coca-Cola didn't become a worse business. The Washington Post's newspapers didn't stop being read. But the market suddenly decided these businesses were worth 20 to 30% less than they were worth the Friday before. If markets were truly efficient, prices would only change based on new information about business fundamentals. But Black Monday wasn't driven by fundamental information. It was driven by psychology, by trading algorithms, by momentum, by fear. The market was wildly inefficient, mispricing assets by huge amounts. This created opportunity for those prepared to act. It reinforced my belief that markets are often irrational in the short term and that patient, rational investors can exploit that irrationality. The seventh lesson is about the importance of liquidity and optionality. During and after the crash, I wish Berkshire had more cash. Not to avoid the losses, we would have lost money on whatever stocks we sold to raise cash before the crash, but to take advantage of opportunities. After Black Monday, many quality businesses were available at bargain prices. If I'd had more cash, I could have bought aggressively. Instead, I was fully invested and had limited ability to add to positions or make new investments at depressed prices. This experience shaped how I thought about cash positions going forward. Cash is optionality. It allows you to act when opportunities appear. Yes, cash earns minimal returns, especially when interest rates are low. Yes, being fully invested usually generates better returns in bull markets. But having cash during crashes allows you to buy when others are forced to sell. That advantage can be worth far more than the opportunity cost of holding cash. Since Black Monday, I've been more willing to hold cash at Berkshire and wait for opportunities rather than forcing capital into mediocre investments just to be fully invested. The eighth lesson is about the media and noise. During and after the crash, the media went into overdrive. Talking heads predicted the next Great Depression. Comparisons to 1929 were everywhere. Experts opined about systemic collapse, about the death of capitalism, about fundamental changes in the economy. It was all noise. Within weeks, it was clear the economy was fine. Corporate earnings didn't collapse. Unemployment didn't spike. It was a market crash, not an economic calamity. This taught me to ignore media hysteria during crises. The media's incentive is to generate fear and excitement because that drives viewership. They have no incentive to be calm or rational. If you base investment decisions on media coverage, you'll make terrible decisions at the worst times. You'll sell at market bottoms when the media is most pessimistic and buy at market tops when the media is most optimistic. Better to turn off the television, ignore the headlines, and focus on business fundamentals. The ninth lesson is about preparation meeting opportunity. I mentioned that I wished I'd had more cash during the crash, but the cash I did have allowed me to make some opportunistic investments. In the months after Black Monday, I made several purchases at attractive prices. More importantly, the experience prepared me psychologically for future crashes. When the market collapsed in 2008 during the financial crisis, I wasn't scared. I'd seen it before. I knew it would pass. I had capital ready to deploy, and I made some of the best investments of my career. Goldman Sachs, General Electric, Bank of America, all at terms that were extremely favorable. Black Monday was expensive tuition, $23 billion worth. But it taught me lessons that enabled me to profit enormously from future crises. If I had to pay $23 billion in 1987 to learn how to make $50 billion in 2008 and beyond, that was a good trade. The worst thing that can happen to an investor is to make money easily in the early years without experiencing real losses. They develop false confidence, think they're smarter than they are, and then get destroyed when the inevitable crash comes. Better to experience losses early, learn the lessons, and be prepared for the next time. The 10th and final lesson is about character. How you respond to adversity reveals who you are. When I lost $23 billion in a day, I could have blamed others, the Federal Reserve for not intervening sooner, the portfolio insurance programs for triggering the cascade, market makers for not providing liquidity, the media for creating panic. There were plenty of potential scapegoats, but blaming others is pointless. I made the decision to remain heavily invested, knowing that crashes happen. The losses were mine to own. Taking responsibility for mistakes, learning from them, and moving forward without dwelling on what you can't change, that's essential for long-term success in investing and in life. I'm not going to change what happened on Black Monday. I can't get back the $23 billion I lost that day. But I can control how I respond. I can learn. I can prepare better for next time. I can apply the lessons to future decisions. That's all any of us can do when we fail or face setbacks. Let me give you practical takeaways from these lessons. First, always maintain a margin of safety in your investments. Buy at prices well below intrinsic value so that even if things go wrong, you're protected. Second, never use significant leverage. The upside isn't worth the risk of ruin. Third, diversify enough to manage risk, but not so much that you dilute returns. Fourth, accept volatility as inevitable and prepare for it psychologically and financially. Fifth, ignore short-term market prices and focus on long-term business value. Sixth, view market crashes as opportunities rather than catastrophes if you have the capital and conviction to buy. Seventh, hold some cash for optionality, even if it seems inefficient during bull markets. Eighth, ignore media hysteria and think independently. Ninth, learn from failures and use them to prepare for future challenges. 10th, take responsibility for your decisions and don't waste energy blaming others or dwelling on losses. If you can internalize these lessons, if you can apply them consistently over decades of investing, you'll do very well. You'll still experience losses. That's inevitable. But you'll avoid catastrophic permanent losses. You'll be positioned to profit from others' panic. You'll compound wealth steadily over time. And you'll sleep well at night, knowing that you're prepared for whatever the market throws at you. Black Monday was traumatic. Losing $23 billion in one day was painful, but it made me a better investor. It taught me lessons that have since made me many times that amount. And if sharing the story helps you avoid similar mistakes or gives you the courage to buy during the next crash, then the experience was worth more than just the financial lessons I gained. Because the best investors aren't the ones who never lose money. They're the ones who learn from losses, stay rational during chaos, and position themselves to profit when others panic. That's what I learned from October 19th, 1987. And that's what I hope you'll remember the next time the market crashes and you're wondering whether to panic or to buy.